Hey, students of iMarkets Live! The following Crypto Academy video is designed to help you understand the psychology behind trading with algorithms and being directly involved as a market participant. Trading contains substantial risk. By watching this training, you agree to the following disclaimer and accept full responsibility of your own investment decisions. This lesson will focus on answering the following questions. Before we continue, pause the video, read through them, and be certain to minimize any distractions. Backtesting in a nutshell is a way for us to approach the market without any real risk. We're going to be analyzing past data to help us interpret what might happen in the future. Now, this is beneficial for testing a strategy or identifying areas of structure, and the best time to do backtesting is whenever you feel like the market environment in the moment is not in a place where you can confidently take a trade, and if you do have a limited amount of time in the day. This is something that when you decide to backtest and utilize the replay feature, it's going to give you that practice and that confidence planning out positions so that when you do identify a setup in the moment, you're able to act on that without hesitation. This system that we're going to use for creating our strategy and building confidence is something that can be implemented whenever you have time. So there is no right or wrong way to do this, but there are a few guidelines that we're going to follow. First, you're going to come onto TradingView and load up the chart of your choice. Next, you're going to be on either the hourly or the 15-minute time frame. Then, you're going to right-click on the chart, go to time scale, and enable session breaks. On the hourly and the 15-minute chart, everything that happens between one blue line and the next is going to be the equivalent of one trading day. After you've put on session breaks and drop down to the hourly or 15-minute time frame, on this retail trading perspective, you're now going to be able to analyze as if you were trading in the market at any given moment. Of course, you can consider what the most recent price action is doing, but using the replay tool is a good way for you to hop into the market and gain practice planning out positions in a way where you can scroll out, look left, click on a random point of data, and because of how you're going to be doing this specific analysis, regardless of the asset, it could be cryptocurrency, it could be Forex. You can now analyze this market in a way according to your specific schedule and habits. So let's say that every day I traded at the 10 a.m. hour and I was going off of the brokerage time frame. So I would fast forward to the 10 a.m. hour, and this is where the market would be. It's at this point where I can implement whatever sort of technical analysis I need. I can add on any indicators, and then I can go ahead and use the long or short position to effectively plan out a potential trade. Keep in mind, when you're doing your analysis, you need to stay on the same time frame if you are in the replay mode feature. Otherwise, it is going to fast forward you over to the most recent price action. At this point, if I were looking to identify a trade based off of this price action, let's say that I was looking to have a 150 pip stop loss. My entry, I wanted to be at the $735 price. So that would be a sell limit order, and I would be targeting around the 3 to 1 reward to risk down at this 688 price point. So if we fast forward that, we can see that on the next hour our trade would have got filled. We would have shifted into profit, and now our target would be achieved in the same day. We can write down 1 win, 0 losses, see if there's anything that we can learn from that position, And now fast forward to the same time on the next day. This is what we'd be looking at on the 10 a.m. hour for the next day. Because we are no longer in that previous position, and because the market seems to have already started to move in this instance, it may be best to evaluate and decide if you would have traded on this day. If you decide to plan a position, use the same steps where you consider whatever technical analysis, you implement the long or short position to plan out a trade, and then you're going to be able to follow the same steps. And then you can fast forward if you did decide to plan a position for this next day and see what happens. But in this instance, I'm going to decide to reevaluate. We're going to fast forward to the next day and we're going to get a little bit more information to work with. Now, the 10 a.m. hour on the next day seems as if price has also continued moving to the downside. So it's at this point where, say, you decided that you wanted to take a buy. Now, you're going to be doing this in a way where you're using a limit order. And for this example, we're going to say we decided that we wanted to enter the market at $650. We wanted our stop to be 150 pips. And of course, we wanted to keep that 3-to-1 reward to risk. So let's fast forward. We can see that we do get filled on the trade, and then price would have stopped us out. Now, you can learn from this process. You can see if your strategy needs to be tweaked. You can also continue moving forward and practicing as if you were approaching the market at the same time, consistently, every single day. Here we are again, we find ourselves on the hourly time frame within a downtrend on the third potential position that we can plan. And let's just say you believe that the market was going to continue going down, and you thought that it could be best to take a market execution. So based off of the current price, you decide to enter. You follow the same risk parameters of having a 150 pip stop, aiming for approximately a 3-to-1 reward to risk. And now when we fast forward, we can see that on that next hour, we almost get stopped out. Price now in profit, continuing to consolidate around our entry. And so it's at this point where we're into the next day. We're still being patient. We can see that if we had waited for more data, this is where price would have been on the next day. So as we're learning through this process in backtesting positions, we can see again, this trade ultimately would have been stopped out, and let's see what happens. As we continue to fast forward the price, we could have decided to take a re-entry on the next day, given the new information that price is displaying to us. And it's in that moment where we can see that price would have successfully achieved our target. So there was not necessarily anything fundamentally wrong with this position that we planned out. The market just simply needed a little bit more time for the setup to happen. And it's in this moment where you're able to then go and reflect and see if there was anything that you could have done to potentially extend how many pips you would have collected on that particular position. This is a very powerful approach for you as an individual to come onto the charts at any time, any day, whether it's a weekday or the weekend, and trade in a way where you can imagine being in the market environment in that specific moment. And as you continue to move forward, practicing with different examples, utilizing different charts and assets as well, you're going to find that this particular style of backtesting serves you in a way where you can go in with confidence when you're looking to analyze the market and identify your reward to risk based off of the parameters that you've practiced with. At this point, we're going to transition and consider a few factors beyond reward to risk ratio when it comes to doing backtesting with the replay function. In the event where you had taken a trade at this line, it is more favorable to see price move to the downside. When you look at the pure risk to reward ratio, however, it doesn't mean that the scenario is going to happen exactly as you believe it could. What we're going to look at next, Bitcoin Cash. We can see that price in the month of May did experience a higher level of volume than even the biggest candlestick for the bears. Notice how the volume on this particular candlestick was much larger than any other candle we've seen today. Yet it is one of the smallest. When we look at the total price movement from high to low, 523, subtract that from 280, we're talking about a 240 pip movement during the month of October 2017. We have limited amounts of data when we're utilizing TradingView and looking at the exchange data feed for a lot of these cryptocurrencies. But depending on which exchange specifically you're looking at, some of them will offer support for larger amounts of data. Some of the exchanges will also show us different data in total. Look at Coinbase, how it strategically removes the candles prior to this sell-off. So from a public perspective, looking at this without the volume, you could imagine that some individuals would be in that optimistic mindset of it is a very good time to buy Bitcoin Cash. This is not a trading recommendation, it is a simple fact. Looking at the long position, if we were to buy some right now below 1,000, we take on the risk that price could go to zero. Looking at the potential for profit, I mean, imagine if Bitcoin Cash went to 5,000. Looking at this data, the month of December 2017, we have 1, 2, 3, 4, 5 candlesticks. We are now printing a little tiny green one. We're on our second hour into this candlestick. There's a long story ahead for this asset. And with the price fluctuations, it's easy to see a 4-to-1 trade right on the screen. In summary, trading with the algorithmic market direction during a movement from one zone to the next is a powerful way to meet your PIP goal for the day, week, month, or even the year when the right opportunity presents itself. Remember, we can trade when the market is rising or falling, and you have a strategic advantage over every other market participant out there. There is nobody else that can analyze the market in the way that you do. And if you do choose to incorporate algorithms into your methodology, whether that be through an expert advisor or through recognizing what the algorithms tend to do, ultimately, this is going to allow you to approach the market with confidence on a consistent basis and to remain level-headed regardless of which direction the market decides to move in.